Connect with the corporate voice. Jana Small Finance Bank in the spotlight. MFIN have been tightening the underwriting guidelines. Let's understand the implications, talk a little bit about what the second half is in store, whether or not the deposit growth is going to sustain. Ajay Kanwal is the MD and CEO now joining in. Thanks so much for taking time out. Now that most of Q3 is behind us, tell us about how recoveries have been so far, because the last time we spoke, you said that you were very confident on strong recoveries in the second half. Are you seeing signs of those trends?
A very good morning to you. And just for most folks who know about Jana or would like to know a bit more, first our bigger businesses, which is affordable housing, micro lab, MSME finance, have done very well in the first half and continue to perform well in the second half. And that's roughly 65% of Jana's book as of September. We did have a challenge in the MFI book, not Jana specifically, but the industry as a whole, and we certainly were dented with that. We do see that there is recovery, which is better in Q3 than we saw in Q2 and Q1. I must say that we may not be the right example for the industry in terms of what to expect in Q3, because inherently, if you take Jana's growth rate in the microfinance business over the last 6.5 years, it's only 1.5% CAGR, while the industry has been growing 2025. So I must caution that my Q3 may not be the industry's Q3. My Q3 is probably better relative to the rest because I haven't had really grown this book since we began the bank in 2018.
Of your total business was coming from MFI space? How much is projected to come from MFI space going forward now that you're not growing this business?
So, good morning. Say 65% is non-MFI. It will become 80% non-MFI. So that's really the trajectory we worked on when we started the bank. And the basic interest was that to build a resilient, predictable bank, we really need to work on secured assets. And certainly when you're doing a lot of public deposits. So we are moving in that direction. Just to give you the number, March 24, we were at 60% secured. September, we have reached 65%. So the trajectory is ongoing and that won't change. We incrementally would like to also get some of the guarantee programs on the MFI book so that the resilience on the microfinance book, of course, we'll do our best in terms of credit underwriting and disbursal, but just to double ensure that, certainly getting CGTMSE, CGMFU programs live with Jana is something that we have already started work on. And we'll talk more about that when we do the quarterly results.
Okay. Now, given that the stress is coming back on an aggregate basis, could this derail your plan to become a universal bank? Because in order to become a universal bank, you need to maintain your NPAs at a certain threshold. Are you committed to keep your NPAs lower so that as per the definition or as per the RBI guideline, you qualify?
So yes, we are qualified to apply. And after that, of course, it is our regulator's decision on whether to award it or not. As of September, we are meeting the guidelines. We are committed to meet the guidelines. Like I said, a large portion of our book is anyway secured, which didn't have any GNPA, net NPA concerns. It was the 35% of microfinance book which had the concern. And we do see, as we are nearly towards November end, we are very committed to make sure that our gross NPA and net NPA both remain within the stipulated guidelines, which allow us to apply for the universal bank.
I was reading an article 2 weeks ago that after a gap of almost 6 or 7 quarters, the liabilities are growing higher than the credit. Is that the situation with Jana as well?
So, little bit of a oddball, yes. But listen, we don't have a big liability book. It's about 25,000 crores odd. First half, we grew about 10%. CASA at about 12. Time deposit at 9.9. So yeah, we grew about 10% on deposits and CASA combined. And we grew about 8% on assets in the first half. So we've had very good growth. And like I would say that, with that size of book, getting good growth rates is not so difficult.
As we look into the future, if you're only growing your unsecured loan book, then so secured loan book, I beg your pardon, what happens to the unsecured business? Because that's where growth and that's where spreads are the highest. I mean, banking is also about taking calculated risk. It's very easy to give loan to home finance. It is very easy to grow the gold finance book. But the bankers are supposed to take risk. I mean, isn't that banking business all about?
So you're right, Nikunj. There is risk in whatever we do, right? The choice we have made is to serve middle of India and to be in the affordable housing business. Yes, I would agree with you. If I had done prime mortgages, then you would have said, listen, Jana is risk averse. It's really going at the real creamy end of society where, margins are low, but risk is low. I think we are at that. We are servicing a large segment of customers where incomes are not definitive in terms of their tax filings, their GST filings, their bank statements. Their balance sheets are a lot more brittle. And that is why we are getting much better margins. So I do think Jana is taking risk, but we are taking risk in a way where we think it is the right risk for a bank with our vintage, making sure that we always are keeping at the back of mind that safety comes first and growth next. And yes, I must say that if you look at an ROA, ROE number of the bank, it does tell you that it's a very balanced answer. It is not less risky, I would say. And I must tell you, whether it's gold or affordable housing, if you don't have full alertness, things may go wrong for us also. So we are very committed that good risk, balanced risk, and making sure we are fully alert.
When we started FY25, you had a projected growth number, you had a projected profit number. But nobody anticipated, and when I say nobody, I mean nobody anticipated in the banking sector that the MFI exposure would turn that ugly. So how does that change your full year profitability forecast? I mean, you've taken a hit, you've been very open, I appreciate that. But in terms of what the starting point at the beginning of the year is versus where you would end, there would be a big difference.
So, Nikunj, some things I can say. We did say we'll do 20% of asset growth. We will do that. We did say we will grow secured, and we began with 60. We are at 65. We will do that. We said we'll go liability at 20%. We have done 10 in the first half. We will do 20 in the second half. So some of our guidances will remain. I certainly think they will, as you see the first half results, we have done 267 crores of PAT. In addition to that, we put 115 crores in accelerated provisioning because we would like our net NPA to remain below 1%, so that allows us to remain within the universal bank guidelines. So yes, we'll not meet exactly the numbers that we had in mind when we started the year. But I would say from a profitably angle, we are running at a PE of 5/7. We still have enough room to be appreciated.
All right. Ajay Kanwal, appreciate your time. Always a pleasure to have you on ET Now, and always look forward to meet you in person for a coffee or maybe for an extended lunch. So let's plan it very soon when you're in Mumbai.
Thank you, Nikunj. Thank you so much.
If you like this video, then like, share and subscribe to ET Now.